So having said that, we'll now get started. And what we're going to do is we're going to put up some information, sort of a, there you go, that kind of information. Now, I know that this is not on the canvas yet, but I will get it there. This is sort of fresh out of the box, and we're just about ready to get started here. Let's see if I can do one thing. There we go. Okay, perfect. All right. Today we're going to start a topic had before, and notice that it could be that the Wi-Fi here is not up to the speed that we would like it. You'll let me know again through the chat box if it's cutting out or you're not hearing me properly. I'm going to talk a little on the slow side just in case. Again, we're starting a new topic, but we'll be using many of the fundamentals we've learned so far. And of course, we'll learn some new fundamentals as we go along. The new topic is really called outbound taxation, where we're taxing our residents, and we're going to talk about the particulars of how residents get taxed. Before we go into the details of U.S. outbound taxation, just want to spend a few minutes to talk about the general principles that are concerns of the nations of the world. And the nations of the world generally have income tax on their residents. There are, of the developed civilized nations of the world, most of them have an income tax as a source of revenue. The income tax has proven to be, over time, a equitable way of raising government sources for funding the government. Whether it is the most equitable way is not the subject of this course, but it's an interesting theory to discuss at times. And for reasons that mankind will better be able to describe years from now after history goes on further, this seems to be the fairest way to tax in a general sense. There are other ways. We'll learn about the value-added tax, the VAT tax, which is prevalent amongst the nations of the world. But again, even notwithstanding having a VAT tax, nations that do have VAT tax also have some level of an income tax. One of the reasons why it is popular is because the United States, I don't know if they were the first ones, but they started it back in 1913, the concept of an income tax on a progressive system where the rich pay more than what would seem to be just a fair share. The rich pay more because they can afford to do so. That has an appeal that has attracted a lot of the nations of the world to adapt an income tax, and in most cases, their income tax mimics the U.S. by being progressive in nature. So having said that there's an income tax on the residents, the question is, what does that cover? Well, we've talked about the concept of covering either worldwide taxation or something we call territorial. Truth of the matter is that most countries are taxing their residents on really what would be considered a worldwide income, but they don't tax everything. Before we go into that, let's just see what we have here, which is the difference between residents and non-residents. Non-residents are taxed only on the income coming from the country, derived from the country, whereas the residents are taxed on oftentimes a worldwide type of income. So let's take a look and go through this slide, and then we'll come back to the concept of worldwide versus territorial. The difference between residents and non-residents. Non-residents are taxed only on income derived. And there's that word. This is, as I say, we will be using the principles we've learned thus far. This is why sourcing is so important, not just for the computation of the foreign tax credit, and we learned the reasons for that, but for countries to understand when they're taxing non-residents, and particularly when we get to that topic, the source where the income comes from often dictates, the first part of the decision, can we tax this? Is it a source that we believe gives us the right to tax. Let me explain that further. A country has the right to tax whatever it wants to, but most countries in the world attempt to tax based on some type of fairness, some type of idea of it's okay to do what we're doing. For example, if someone comes into the country as a visitor and they're just touring, why should the United States or any other country, if they're hosting tourists that are good for the economy, why should they suddenly say, you stepped foot in our country one day 10 years ago, therefore we're taxing you on all your income, no matter where you earn it. We don't care its source. I mean, that, besides the fact that it would be hard to administrate, it would be so inequitable that it would make no sense to do anything like that. So the concept that countries are following, although there's no international rule requiring them to follow it, the concept that the countries tend to try to follow is what's fair for us to tax. Certainly, the United States, which taxes worldwide, does that based on the discussion we had in class so far this semester, that its citizens are being protected no matter where they are. If a country decides not to tax their citizens worldwide, then they're going to be concerned about taxing them on the income that is sourced to their country and not tax income that would be sourced from some other country. That would be the general principle. So that's why the sourcing rules become important. Continuing along, so while residents of a country are taxed oftentimes both on their domestic and their income derived from outside, which would be foreign source, that is true. The non-residents will only be taxed on this income, generally speaking, sourced from the country itself. This tells us a whole lot, this last part here, that residents of a country are taxed on both their domestic, which tells us that indeed most countries are following some type of worldwide system, although we don't call it that. The reason for that is because they limit the amount of worldwide income that they'll tax in the country, whereas the United States has no limitation. So countries like the United States with no limitation are called worldwide. Territorial, as it turns out, are countries that tax for sure resident income sourced inside their country, but also sourced some foreign source income, and the limitations vary from country to country. So the typical pattern, which means most countries in the world tax their residents on both domestic source and at least some items of foreign source, some. Corporations and other legal entities, sort of like we don't need to be thinking about trying to be equitable to them because they're not the beneficial owners. The stockholders are the beneficial owners. So in the concept of taxing businesses, we're not too concerned with exactly how we tax them. The issue with corporations and other business entities is that countries tend to tax based on where their activities occur. Because if their activities are occurring in your jurisdiction, let's say your country, even if it's not let's say you're living in France and a U.S. corporation is doing business there, you're going to tend to want to tax that U.S. corporation in France because they're using resources of your economy. They're using your citizens to sell product to or to service. So if you're there, there's a tendency amongst countries to feel that it's sourced, the income is sourced there, and income sourced there, even if it's not a resident, if the corporation is not a resident, it should be taxed. And think about whether that's fair or not is not part of the consideration because it's the shareholders that are the ultimate beneficiaries of that income. All right, so let's talk about the tax consequences of residence. And I think we begin to see what that means. That means that if you're a resident of a country, you're going to pay tax on all the income sourced in that country and some items sourced elsewhere. And you'll have to follow those rules. That's the main consequence. And what is residency? Well, we've talked about residency in a general sense. There's this 183-day concept, and how do you count the days? And then there's where were you born? And that may give you residency right away, depending on which country you're in. So each country will establish their rules of who's considered a resident. And business entities, of course, we learned that as long as they're formed here, they're automatically considered to be residents of our country. All right, so continuing the same theme, some countries, certain types of foreign source income, typically business income derived from another country, are going to be exempt, while others will be subject to residence tax. Let's go through that a minute and just see what that means. It means that while the United States is this worldwide taxation concept, it's not what you typically find worldwide. What you typically find is the following. Let's make up some countries. Country A has their definition of residence, and the residents of their country will be taxed on all sourced income from the country A. That makes sense. If a resident derives business income in country B, country A doesn't tax that in country A. That's the typical scenario. Whereas if country A citizen earns interest or dividends or royalties from country B, that may be subject to tax. Again, it's going to depend on the rules of country A. Moving along, as a result, just because a country is described as taxing on worldwide doesn't mean that it taxes all foreign source income derived by residents. So again, summing it up, the United States is a unique country in taxing all worldwide income. Currently, there's maybe 18 countries that can claim that as their frame of taxation. And the rest of the world is some hybrid of that, where the residents are not taxed on all worldwide income. The arguments for or against how income should be taxed from sources outside of the country where someone's a resident is an argument that has not been solved. You may have your opinion, and that would be good for you to have your opinion of what makes equitable sense. One of the reasons why it hasn't been solved is while I think authorities thought they had it solved back in the 1913 through 1920 and 1930, there was committees that had been formed worldwide to determine basic tenets of worldwide taxation, and we're living with those basic tenets today. And the reason why they thought they had it right back then is it might have been right for the economy at that time, but the economy's changed. We now have a worldwide economy. And if country B, in my example, country A's residents versus country B, if country A's residents go do business in country B and country B's income tax is a lot lower, then country A's residents are attracted to go to country B to do their business because it's not going to be taxed at the higher rates in country A. So then maybe that's not a good idea. Maybe that doesn't work. And that's part of the argument. Is that a good idea to encourage people to go to country B? Whereas what did country B do? Why did they lower the rates? They lowered the rates to attract business, to attract people to do business in their country. And this leads to the saying that I gave in class maybe a week or so ago. This leads to what we call the race to where? Anybody remember? It's the race to what? This scenario of if countries don't tax worldwide, then there is a race to, anybody remember that? I won't give you any hints. Of course, that doesn't look like what I'm about to say, so that doesn't count. Try to see if we can undo that. Try again. It's the race to zero. That's correct. Zero tax rates. The country with zero tax rates may actually be, in theory, may actually be doing a good job for their citizens because it will attract foreign business owners to come do business in their country. Again, highly controversial economists who study these things and theoreticians who study it. There's opinions that go this way. There's opinions that go that way. See, this way, that way. What about losses? How should losses be handled? Well, it seems like if we have the concept of treating uh, losses as the United States does, where if you have, let's say you have the U.S. over here. Let me see if we can do this. We have some space here. I might be able to do it. So we have, let's say, the U.S. here, and they're taxing worldwide. So what happens is over here, it's ABC country, and as a result, ABC country's got, let's say, give them low rates. So a U.S. company decides to do business in ABC country because of the low tax rates. And what happens if there are losses here? Since the United States is a worldwide taxation, those losses are netted against other U.S. source income. Meanwhile, that might make sense because we tax worldwide. What happens, however, if the USA company can later, when they start making profits, what happens if they can make all those profits foreign source and not have the taxed in the US? Well, that's going to be a dilemma that we're going to learn about today. So I'm setting it up for here. So here's our first sort of, not a polling question per se, but a thought question. Think about this. US, you gotta get the right spelling. Um, there we go. U.S. treats its residents on worldwide taxation. Okay. But here, we've got a situation going where if we can turn the tide and suddenly change ourselves over from being a U.S. resident to something other, and it becomes foreign source, so when we have profits, they don't get taxed in the United States, but the losses were used. So how can we do that? That's what I want you. That's what I just want you to put in your heads. You don't have to have the answer, but think about: is that inequitable? That's why we raised the topic of the treatment of losses. What should we do with these? Because suppose the U.S. company over here can use the losses to offset other U.S. source income, but then get the profits when they start making profits, get all those profits outside of the U.S. Think about that. Okay, so food for thought in this introduction. One of the problems with all this nice theory is how do you administrate it? How do you put it into practice? So one of the key fundamental parts of worldwide taxation, international tax, that's developed over the course of time is there's this theory of business taxes are taxed at its source, whereas portfolio income is subject to withholding tax because it can be administered. Payers from one country to another country can do withholding tax, collect the tax before the payment's made, and that solves a whole lot of problems about collecting the tax. Whereas business tax, it's tough. You have multiple customers, maybe millions of customers that are doing business with a non-resident corporation inside their country, and you can't ask those millions of customers to withhold taxes on their transactions. It would be a nightmare of record keeping. So again, this is just a theory of an approach to international taxation. What are some of the exceptions to worldwide taxation? So it would be that business income tax that we mentioned. And some of the other items that might be exceptions to worldwide taxation would be things that are tough to administrate. That would be. So if you want to study tax law, either locally or internationally, and we said that understanding the reason behind the law is a great way for learning it and remembering it and getting the principle of it, so that when you delve into details, if you want to understand why does the detail make sense, if you understand the principle of the law, then it would start to make sense. So when you see exceptions to worldwide taxation in other countries, again, the United States won't have that by and large, but when you see it with other countries, or is there another reason? Or maybe it's an economic reason, maybe it's a promotion of international business. All right, there's going to be rules about temporary residence. So each country in the outbound taxation will be concerned about who's a temporary resident and tax them accordingly. There'll be issues about people who want to leave the country. We talked a little bit about that. And there's something called trailing taxes. I want to just mention this. Last week we mentioned the exit tax in the United States, which is a tax when you denounce your citizenship and you leave. So this concept of an exit tax, the tax to pay for leaving. That's basically what they're saying. You got to pay a tax to leave. Uh, in addition to that, capital gain exit tax that we spoke about, and again, to remind you, the concept of U.S. exit tax is that you act as if all your assets sold, pick up the gains and losses, and whatever it nets out to, pay a tax on the net gain if there is a net gain. And then there's exceptions. It's really for much wealthier people. But in addition to that exit tax, we also have what's called a trailing tax, and that is for the next 10 years, you have to continue to pay tax to the United States on certain income, just out of purposes of saying this is what it costs for you to leave. Um, and other countries have similar rules. And then there are rules for residents for part of the year. And these are the concepts that we'll be talking about over the next couple of weeks, or classes anyway. Okay. Enough of the theory, because that's really for tax policy people and theoreticians. But I just wanted to get your heads wet on the concepts of what we're going to be concerned about as we delve into outbound and then later on inbound taxation. You're going to see, I think the one thing I'd like to say now is what you're going to see is you're going to see that when I mentioned to you that what one country's rules for outbound taxation becomes another country's rules for inbound, because someone who's going outside of their country is coming into some other country. So that clash is something we're going to be encountering over and over again, because of the fact that we're going to be looking at first U.S. citizens going out, and then we're going to look at people coming into the U.S. All right. What happens when a country, what are the implications for foreign operations? Let's talk about that. First of all, why is it that we have, and we're going to really be speaking mostly about businesses going overseas, U.S. businesses. So, by the way, just for the purposes of knowing where you are, but the discussion heretofore was more of a just get you thinking in terms of the theory of international tax, what some countries do, what some countries don't do. From time to time, we'll look at a little more detail along those lines. Now we're going to go back to approaching international tax from the U.S. perspective, keeping in mind that many of the principles we'll learn here are principles we're going to find with many, many other countries as well, and I'll point that out as we come to them. Moving into the concept of the U.S. outbound taxation, why do U.S. companies go overseas to do business? So here's just to give you an idea, is it was generally, and it still is true, it's generally the outgrowth of an export business. Country in the U.S. does selling or manufacturing of goods, and suddenly they find with the change of, not suddenly necessarily, but they find over time that the change to a worldwide economy means that their goods, their clothes, their shoes, whatever they're manufacturing, has a market overseas. So why not take advantage of that market and sell overseas? So U.S. businesses often enter foreign markets, and they do it in a variety of ways. Sometimes they'll initially do it through independent sales representatives. So, for example, we're going to give you a real life example. Uh, we're going to buy a furniture client who is definitely doing business worldwide these days. They initially hired representatives, I'll call them, people to represent their company, their furniture in a foreign country. And what they said to them is that if you can make a sale, we'll give you a commission, we'll pay you for that sale, and then we'll ship the merchandise over. And what these people typically did, these independent reps, they made up their own hours of when they were going to work. They sold whatever way they wanted to try to make the sale. They were not told what to do by my client, and they were completely on their own as to how much effort to put into it, what kind of effort. Their motivation was they would get a commission for the sales that they made. So that, and what they often did is they often not only represented the furniture that my client was selling, but they often represented other companies' furniture and sold that as well. So the advantage of using an independent rep is that it doesn't cost you anything unless they sell. They know the market in their country where these independent representatives live because that's what they do. They sell, and they know that product. Usually their independent reps sell that product exclusively, meaning they sell furniture, or they sell clothes, or they sell shoes. And since they know the product, they know who's buying, what kind of things they buy, and they can take, say, companies of the U.S. that have different styles, let's say the furniture, so they know where to sell that style. They know who's going to buy that style, so they can lead the company to the right marketplace, the right place to try to sell their furniture there. And so the independent reps is a great way to start business in a foreign country. Of course, it could lead to you could also describe the independent reps, and when they grow in their foreign country, they grow. They could be called a distributor, meaning it's a big company. It's not just one person. Independent rep sounds like, and it usually is, referring to just one private individual, and that's what they do. They represent many manufacturers, many distributors of merchandise, and they sell for those people. When it comes to a distributor, that's when you take the concept of being an independent rep to the higher level. You become a company. Instead of just being by yourself, you form a company with salespeople and office people to be able to handle selling this product in behalf of other companies wherever the a distributor, other than the fact that it is going to be selling many different products and and have many different salespeople, it's really the concept of independent representative taken to the next level, just an expanded picture of that. Or companies enter foreign markets, the typical way is that they'll start using an independent representative or a distributor. And then as they see that their product is doing well in a particular country, let's say you go to Mexico and you hire a distributor to sell your product, and all of a sudden the sales are skyrocketing. So the next step often happens where they send over their own representatives. The company will send their own representatives there, and they may even set up an office there. And that's what happened with my furniture client. After a while, the independent reps were selling pretty good. They got a good thing going. So it's like you're giving a commission to these people. It's losing some profit. So the old story is cut out the middleman and my client eventually set up their own office in foreign countries and got their own salespeople who would work for a little bit less, and so more of the profit stays in the hands of the country. But at that point, we may be doing something that's interesting. And here's what we'll mean by that. So the number one bullet is that it's generally an evolution from independent sales reps or distributors, and then to we send our own reps, we have our own office, and we're making our own sales. That's the general evolution. Again, no rules to this, it's just the way businesses often operate. But the point of this is something to keep in mind. Again, another general principle of international tax. Uh, Concept of not just the source, but when do you tax it? When do you tax it? It would be one argument to make that when my client first started making sales to foreign countries using independent reps, that those sales could have been considered foreign source because my client would have for sure had the title pass at the point of sale rather than here. So that would have been definitely, remember that's the title passage rule. I don't know why I'm trying to draw this. It'd be much easier to type it. So the concept is the title passage rule is what we're looking for. There we go. And so it would have been real easy for my client when he first started setting up doing business in a foreign country to make sure it's all foreign source by having the title pass in the foreign country. That can be controlled by contract, no problem. Why is that helpful? Because it means that it for sure is foreign source, and that helps the foreign tax credit, as we now know. Beyond that is the fact that we can say that it's not going to be subject, it'll be still be subject to worldwide taxation here in the U.S. So, but what we have increased the foreign source. Question becomes, what if the U.S. business doing this independent sales office in the foreign country? What about the foreign country, ABC? In other words, on this side of the ledger, over here, when it comes to the U.S., it's one thing to say it's foreign source, but it's still subject to U.S. tax. How about ABC country where we're doing business? Maybe the issue there is that it's not even going to be taxed there, even though the title passes there and it's considered source. It might not be taxed there. Maybe they don't, or maybe it's a lower tax rate. Of course, we'll still pay worldwide taxation in the U.S. back here, but an ABC country concept is that it might not even be taxed to my client when the business is done through independent sales reps. That's a good way to show it to you. Just cross it all out. All right, what am I trying to do here? I'm trying to underline independent sales rep, that while my client's doing business in a foreign country is using independent sales reps, the reps are the residents of that country. The distributors are the residents of that country. They'll get taxed on the income they make, but while all I'm doing is letting them make the sale, could be that my client doesn't pay tax at all in ABC country. So so while they're using these independent sales reps or distributors, it could be that the rules and laws of that country would make it such that there's no tax to pay. Zero tax for my client. However, when suddenly we are, again, I don't know why I'm saying suddenly, it's an evolutionary process, but when we cross the line, and the line could be, depending on the laws of the country, the line could be when we pass from using independent sales reps to suddenly having our own reps. This is everything's sudden today. I don't know why. But when we have our own reps or our own office, look at that, our own office, suddenly our office is there. When that happens, we may have crossed the line. So now we're not just doing business in the U.S. We are and only subject to U.S. tax, but now ABC's now you're going to get taxed. So it's going to be no more zero tax. You have an office. You're making sales there with your own people. That could change the flavor of the international tax scheme at this point. Yes, we'll still be taxed in the U.S. We'll have the foreign tax credit to avoid the double taxation that we've learned about. But now ABC has the right to go just to us because we have our own people there, our own office. So you see what's happening here is that it's a movement of business, a company wanting to do business in another country, and they begin to, at some point in time, touch the other country from a jurisdictional standpoint, such that when they make that touch, when they cross that line, now that country is going to be considered doing business there. And while they may not be a resident country there, they will be subject to the inbound taxation rules of that country. So you have outbound here, U.S. Okay. So I have U.S. company going out, see, and then the foreign countries here, and then certainly when you cross the line, and what is the line for every country? It could be different. The line could be addressed in treaties, and that's how we'll know at what point the jurisdiction changes such that the other country is going to tax it. Okay, other reasons for having foreign operations is I've got a good patent here. A drug company might have a patent. Let's license that patent to a foreign country, uh, make money. Makes sense. But the money that's being made when we're licensing that patent or that royalty, that is foreign source. And so the question is that country going to tax it? And what does the U.S. do about it? That brings up one more topic in terms of the issue of the worldwide taxation that we've been talking about. In order to do that, let me just do the following. Back to our whiteboard for a second. We mentioned earlier tax worldwide, basically, but not all foreign source. So why am I saying this? Because what do they do to avoid double taxation? Well, what they do to avoid double taxation is they're not taxing all income. That's how they do it. So where you are in the U.S. and you're taxing all, that's why the U.S. must have, in order to avoid double taxation, the foreign tax credit. So I just want to make that as a clear indication that one reason why many countries are worldwide, in theory, but to avoid double taxation, they tax there. I am still here. Okay. Try to move it this way, if that would help. We shall see. Okay. All right. Let's go back to our slides of the day. All right. So once we've moved from doing business just within one country's borders, we've crossed borders, and we're doing businesses elsewhere. And the tax concept, and this really sums up what I was just saying. Number one, we can, if we're using independent reps or distributorships, maybe we're not taxed yet in the foreign country, and only the independent reps and distributors. When we have our own company people there, if we have an office there or have what we call a permanent establishment of an office, more about that when we get to treaties. At that point, our income sourced to that country may get taxed to that country. And that leads to number three, I was saying at the same time, also an office there could lead to taxation in that country. So then we would have a situation where the U.S. company is being taxed in the U.S. under worldwide and being taxed in the foreign country. And whether the treaty may also dictate when do we get taxed, at what point do we get taxed, at what point have we crossed the line so that our business dealings in another country are also taxed there. The treaty would tell us how much economic activity has to happen before we pay tax in the host country where we're doing business. And the treaty will also address maybe withholding taxes when dividends are paid back to the U.S. Let's get that squared away. Let's just talk about the basic theory of what it's going to look like. From a business standpoint, you're going to have U.S. company. From a business standpoint, you're going to have U.S. company doing business in ABC country. When they've crossed the line and dividends are paid, not dividends, but profits are made, the US can you just, is the sound, I'm going to wait a second. I've been distracted the past couple minutes watching that and thinking maybe the sound's not so good. So if someone could just let me know if I've got a good connection here. I don't see anybody telling me. Let's see. I think it must be happening. I think it's happening on my end. Ooh, that's not good. How bad is it when it's cutting out? All right, yes. Is it a problem? See, it still cuts in and out. So when it cuts out on the videos, the sound's cutting out. And that's been a distraction to me. Yeah, yeah, okay. That's why I've lost focus. Okay. All right, let me think about what to do about this. Not a good thing. All right, tell you what, let's take a break. I'm going to leave it on here, and I'm going to think about see if I have a better connection from where I'm at. So everybody go on break for 5 minutes. I'll be back. Okay, I'm going to switch to a different um, internet connection, and as I do, we might lose you. So let me put that down. Um, if uh, all right, so don't leave right this minute, but if the switch causes us to lose the connection, you wait, you come back to me. All right, so I'm going to switch now. Let's see what happens. Okay. All right, let's do the thought video off. Okay. All right, here's what we're going to do. It looks like everybody's there. Ian, since you were last on the list, could you put in on the chat box if you're still hearing me? Okay. Here's what I'll do. I'm going to start again from where we last left off. Right. I turned wrong way. All right. So hopefully you'll hear me and it'll work better. All right. So just let me know if it keeps cutting out. Just let me know. All right. So that's the way we'll do it. We'll see if this works better. All right, let's set the stage again. I was getting distracted before, so let's go back. And I'll every once in a while check the chat box. So if it's cutting out downlights, just let me know. Okay, to get started again. What we're going to talk about now is we're going to talk about exactly what's happening when you go overseas. If you're in a U.S. perspective, going overseas will cause the following to happen. You will be at first, as you go through the process of going overseas, first you won't cross the threshold of being taxed in a foreign country. Only your reps will be taxed. But when you go to the point of it's your own salespeople, your own office, most countries will then have their inbound taxation laws trigger, and you're going to be taxed in the foreign country. We're concentrating more here on the outbound side, which means that the result is that you're going to have taxation here in the U.S. on these foreign sales, you would have had it anyway, even before you were being taxed in the foreign country. But once you get taxed in the foreign country, then you're subject to worldwide taxation. And you're not real pleased about that because oftentimes the foreign country you're doing business in has lower tax rates. Like over here with ABC, they have lower tax rates, but the foreign tax credit helps you um, in the US, but you still wind up paying the higher of the two. You pay the higher. So the lower rates don't really help you. You wind up paying the higher of under the foreign tax credit. Let's go forward and see that a little bit. You have what is meant by US and foreign, that's the sourcing rules, and we talked about that. What about structuring foreign operations? What are we going to do there? All right, so we're going to have two ways we can have our operations go overseas. We can do it through a branch of the US company, or we can set up a foreign corporation. And that would be very interesting if we set up a foreign corporation, because it would make a difference between a branch versus the US company. So let's talk about that for a minute. Here's what I mean. If the US company just goes into another country, and let's use as an example, we'll just call it ABC country or A country. We go to I'm sorry, let's do it. Make it easier. We'll go to B country. All right. So we go to B country and we do business, but we do it as a US corporation. That means that it's a branch of the United States company. That's what this branch concept means. So the result is that all the income earned by the branch will be taxed in the US, and it may even be taxed in the foreign country, country B, once the threshold has been crossed and we're considered to be subject to their inbound taxation rules. That's versus if we set up foreign corporation in country B, which will certainly be taxed there because it's going to be a resident of that country. But given that if we do it as a foreign corporation, then that foreign corporation in country B is not taxed in the US because it's not a resident of the US. That's the big difference between branch versus subsidiary. And so that's going to be part of our consideration as to which way do we do business. Concept of branches in country B is that the losses are part of our U.S. tax return, and so they offset other U.S. income. And on the other hand, that's if we have losses. On the other hand, if we have profits, they'll be subject to U.S. tax, and the foreign tax credit will help mitigate the double taxation that'll come in. If we're a branch, we make profits in country B, there's something called repatriation of those profits. That's where we're going to send the profits back to the U.S. company. Remember, the branch is not a separate company. It's not a foreign company. It is specifically just the U.S. company doing business overseas. So it can send the profits back to the U.S. parent company that's there in the United States. They can send those profits back anytime, and there's usually not withholding taxes. Why? Anybody know why? What do I mean if it's not subject to withholding taxes? Why would that be? Because it's not what? Sending the profits back to the United States is not subject to withholding tax because it is not Anybody know? Yes. Yeah. Does anybody know what is it not? It's not a what's subject to withholding tax here in the United States when we pay it, when a U.S. company pays it to its shareholders. It's not a dividend. So the advantage of the branch doing business in this other country is that you generally do not have an issue with sending the profits back to the U.S. parent company. And that's because we're not talking about a foreign corporation in the foreign country, we're talking about the U.S. doing business there. Again, the branch concept is it's just the U.S. company, but it's gone overseas doing business in B. On the other hand, what we call a subsidiary is the U.S. company sends assets, I gotta start typing better, sends assets to B, a foreign corporation. And that what's going to happen then is that the foreign corporation will have to follow the rules of the country that it's in, which would be, let's say, again, let's just use a generic name for the moment, country B. So it's going to follow those rules and pay tax there, but it's not a resident of the United States, not a U.S. resident, and therefore no tax in the U.S. until pays dividends to U.S. shareholders. So now you get to see a real cool part of doing business overseas is that for a U.S. company, if they do business there as a branch, meaning they don't set up a separate entity, they just go there and start doing business in that country, all of their worldwide income is taxed to the U.S. company as if nothing happened. And it doesn't matter when they send the profits back to the United States company bank account. That's not a taxable event. They pay tax on it as they earn it. If it's a separate subsidiary doing business in another country, it's a foreign corporation. How did they set it up? They set it up by sending assets to the foreign corporation to get it started. And they just do business in this other country as a foreign corporation. It's foreign to the United States. It's a resident corporation to country B. The subsidiary is a resident country, a resident corporation to country B. So everything looks pretty good at that point, because until dividends are paid, that's the whole issue. So if you hold off paying dividends, then you can wind up capturing lots of profits made by the corporation in country B, and you don't pay U.S. tax until the dividends are paid. So that's exactly what's been going on today. It gives the company more control of the timing of U.S. income tax. Compared to if it's a branch. So if you have a subsidiary, you can hold off recognizing the profits from that subsidiary by not paying dividends until you're ready. And there's a lot of good reasons for that. Now, and Ian actually emailed me about this earlier in the week, if the issue is that the country B has real low rates, then paying a dividend to the U.S. shareholders is not necessarily desirable. I'll say paying the dividend, because eventually the shareholders want their dividends. To U.S. shareholders. So what happens is what we have today, we have trillions of dollars that are accumulated overseas that are captured, or captured is a good word, or they're sort of hold hostage because these U.S. companies that have gone overseas set up foreign corporations to do business there. The United States shareholders don't pay tax until the dividends paid. So there's, by most estimates, it's getting close to $3 trillion that's sitting overseas in foreign companies that are really owned by U.S. Companies here, but since they're foreign corporations, they're not paying tax in the U.S. until the dividends are paid. That's one reason why we have this situation where we have a U.S. parent company owning a foreign corporation. But another reason might be that B countries offering an incentive to do business there, but it's only by becoming a local corporation. So that's another reason why you may have this situation where it's not a branch, it's not just a offshoot of the U.S. company doing business in a foreign country. It could be that there's an incentive given to the United States or any other outsiders to do business in their country, but the incentive is only if you incorporate locally there in their country. So that's why you might wind up with a subsidiary relationship with your foreign operation. Before we talk about this, let me just mention one other reason why you might wind up doing business in another country as a foreign subsidiary as opposed to a branch, and that's because, and I had this with my furniture client, local law does not allow you to do business in the country unless you incorporate there. That was the case with Jordan. In order to do business in Jordan, you have to get a corporation set up there, and you had to do it with a Jordanian citizen owning at least 50% of the company. So for my client to do business in Jordan, he had to find a Jordanian citizen willing to be a 50% or more shareholder. That wasn't too hard to find. Trusting that person is a little more of an issue. But that's a different story for another day. So how does this work? Again, I'm going to repeat what I just said. What it means is that if the U.S. business is doing its business in a foreign jurisdiction by having set up a foreign corporation there, that foreign corporation will be a resident of country B, pay tax there, but generally not pay U.S. tax until, and this is the principle I want to drive home, until dividends are paid to the U.S. shareholder. All right, so I think I've driven that point home. Spelled it wrong 10 times, but I think you got the picture. You got the message. So that leads to the next part of the decision tree is that it is a foreign corporation. When do we classify it? When does the U.S. tax law treat it as a foreign corporation? So the U.S. tax law defines it as an entity that provides limited legal liability protection to all of its owners, and that's going to be considered to be a taxable entity, thus a foreign corporation. And the case where the foreign entity has at least one owner that doesn't have limited liability will not be considered a corporation. So that's B. It's called fiscally transparent because there's at least one person has liability issues, they're not protected. So B is, well, you should say it this way, not a corporation in the eyes of the U.S. The reason why we're saying it this way is because in the foreign country, it could be that they don't have what is called a corporation, or what they have there has different laws than our corporation. So we have to be able to, from our perspective, define what you are in the foreign country. It may look like a corporation, so we'll consider it a corporation. It may not look like a corporation, so we won't consider it a corporation. It's a question of facts and circumstances. Some entities in some foreign countries will almost look exactly like our laws for corporations, but some will not. So how do we know, is it a corporation or not? One way we know is that the Congress, I should say the Department of Treasury, in their Treasury regulations, has established what are known as per se corporations throughout the world. They list about maybe 75 countries, and in each country it lists at least one particular type of entity that will be considered to be a corporation for U.S. tax purposes. How did they get to that? Well, they studied what the rules are. They studied what the situation and facts and circumstances of that entity is allowed by that country, and they determined that it was close enough a corporate structure to be treated as a corporation, and so they're called per se corporations. Why is that important? We're going to find out. Right now, what I need you to do is to put in your bag of tricks of understanding of this subject matter is that if the regulations define these per se corporations, and they do, that's where it's found. So I'll say it's found in the Treasury regs. And so they're going to be called, the language used in the regulations is the following. Here's how it sort of sounds. It says, these corporations in these foreign countries, or these entities in these foreign corporations, they don't call them corporations, they call them entities. These entities will be considered as corporations for U.S. tax purposes. And in the language, they say they will be considered corporations under U.S. tax per se. So that's where the expression comes from. Let's look up what it means. Always wanted to do that, so hold a second. We'll get dictionary.com up here. It's probably good to understand the expression. Here we go. It means intrinsically, or inherently, or fundamentally. So let's use the word fundamentally. It's fundamentally a corporation for U.S. tax purposes. That's the concept of per se corporations. Now let's keep that in the back of our mind and try to understand why that's going to be important. So here we go. This gets a little complicated, but if you haven't had business entity taxation, it will be somewhat very complicated, but we're going to get through it. The United States has what's called the check the box rules. Check the box rules means when you're not sure whether you're a corporation or not, you can make the decision to tell the IRS how you want to be taxed. These rules called checkbox are called check the box because to do it, it's simply a form that you get from the IRS. You can imagine where I'm going here. That sort of looks like a IRS form to me. They're always crooked. And you just check a box. The box that you check will tell the IRS, consider this entity to be partnership, corporation, S corporation, gives you a variety of choices. And the check the box rules allow owners of certain foreign entities, notice the word certain there, to elect, or check the box if you want to call it that, whether the U.S. should treat the entity as a taxable entity, meaning a corporation, or as physically transparent. And what does physically transparent mean? That's important here. It means one of two things. If it's one owner, it's a sole proprietorships. And if it's two owners, vested, it's a partnership. Fiscally transparent means that there are no dividends. Whatever the entity makes, whatever profits are there, they get taxed immediately, and they get taxed immediately worldwide to U.S. residents. Now you see why we needed to learn about the per se corporations, because check the box works for everybody except per se corporations. Inherently or fundamental corporations, which is what per se means, and they're inherently or fundamentally because the regs say they are. How do we know if it's per se? You just go to the Treasury regs to find out. It's not something that we decide on our own. It's not something that we figure out on our own. It's either going to be in the regs or not. But if it's in the regs as a per se corporation, you can't check the box. And there we go. I had it close. I was saying it's like 75, but there's 80 foreign entities that will always be treated as corporations. Like, for example, if you go to the United Kingdom and you set up what's called, I believe, a chartered company, you can check the regs. That is, I believe, a per se corporation. So you can't check the box on that one. And you might say, well, why do I want to check the box? What's that got to do with anything? We're coming to that. So we're putting together a couple facts. Per se corporations, number one, that cannot check the box. Other entities which might look like corporations in other countries, but we can't determine if they are. They might be, they might not be. We would have to make a decision whether to treat them as a corporation or not, or to treat them as not a corporation. So to check the box makes it easy. Let's do a little bit more about what I'm talking about here. Let me just see what's next. Okay. So to get this to be understood, before the check the box rules, if the foreign subsidiary that you see in this picture was not a per se corporation, but it had some of the characteristics of a corporation in the foreign country, you would have had to make the determination of what is it to determine how the U.S. is going to tax it. The uncertainty was mind-boggling for U.S. taxpayers, because if they said it was a corporation and the IRS said it wasn't a corporation, the tax results could be enormous. So having that uncertainty was not a great place to be able to do business and know exactly how to treat things for tax purposes. So as a result, the check the box takes the guesswork out, because if you check the box and you say it's not a corporation or it is a corporation, there's no question from the IRS. This works, as we said it one more time, this works for everything but, what is it? The per se corporations, which are listed in the regs. All right, now you understand that when you're setting up business in overseas, see the C's there? When you're setting up business overseas, you might set up business in a subsidiary, and do you really have a foreign corporation subsidiary or not? So you check the box to determine which way do you want it to be. You could check the box and say it is a corporation. You could check the box and say it's not. The U.S. company owns it. This is Uncle Sam taxing it up here. So what's the planning? The planning works like this. In the beginning of a business going overseas, sometimes we budget for good business reasons. We budget that we're going to accept losses, and we expect losses in the first couple of years. Profits will be later. That's just a typical part of doing business. A lot of times it makes good sense that that's an expectation that's worthwhile making the investment. If you have, just realize the spelling there, okay. If you have a U.S. company doing business in a foreign country and it's not doing business in a per se corporation, and you're not sure what it is, you're going to check the box to take away the uncertainty. And here's what you are going to think about doing. You're going to think about, number one, when you're expecting losses, to check as a fiscally transparent entity. Thus, it won't be considered a corporation, and that means that the losses flow through, and I'm going to illustrate it here. I know this is getting a little complicated if you haven't had business entization, but bear with me. If the foreign sub had the box checked to be fiscally transparent, not a corporation, the losses, and let's put them in red, the losses will be flowing through. I'm getting there. Meaning they'll be recognized on the U.S. company's tax return up here, offsetting what could be other income that the U.S. company's making. This is a good thing. It's not good to have losses, but if that has to be part of the process of moving into a foreign corporation, it's quite acceptable to accept the losses from the business standpoint, but it gets even better if from the tax standpoint, the losses can offset other income that the U.S. parent company has. So in this case, you would check the box in the beginning to be fiscally transparent and let the losses flow up to the U.S. company. That is not going to be the case if it's a corporation. So if you check the box to be a corporation, the losses do not flow through from the foreign subsidiary if the foreign subsidiary is a corporation. And if it's a per se corporation, the losses do not flow through either. So the bad news is if you're a corporation and you're going to be treated as a corporation, as a foreign corporation, you have losses, they won't offset U.S. income from other sources. That's the bad news. But if you have profits, you want to be recognized as a corporation so that you don't pay U.S. tax until the dividends are paid. That's like this is the concept. This is what you got to get. The biggest concept you got to get into your heads is that foreign entity doing business having losses, you would want, if you can plan it this way, you want that to be a fiscally transparent entity so the losses flow through to the U.S. parent. Whereas if there's profits, then you would more often be desirous of having the foreign entity be a corporation so that the profits are not recognized in the U.S. until dividends are paid. Now, even in the event that profits are made and recognized in the U.S., we know that we have foreign tax credit to offset the double taxation. So when dividends are paid, the foreign tax credit helps offset that. So we're going to just revisit the foreign tax credit for a minute. We know the sourcing rules for gross income determine the foreign source income for U.S. tax purposes. We've learned that. Characterization of income as a foreign source income does not mean the income is subject to a foreign country's tax, but the source is important for the foreign tax credit limitation here in the United States. So these two sentences over here should be understood at this point that the sourcing rules do not necessarily mean that's where it's going to tax, but it's certainly important for the foreign tax credit. Let's do a quick review of what we learned last week. Always a good thing to do. We talked about sales of inventory, gross income from the sale of inventory that is purchased. That's the key. So purchased inventory is sourced where the sale occurs. That's the title passage rule. And we can control that. This illustrates the point is that if the U.S. distributor has the title passage to the in the U.S., then it'll be U.S. source income. So here's the illustration. Here's how it works. Let's see how it works. So this is a good way of illustrating it. If the title passage and change of ownership is here on the U.S. side of the ocean, it's going to be U.S. source income. And if the title passage is on the other side of the ocean, it'll be considered foreign source. That illustrates the point. So no, there's not too much problem there. But the point to learn is that title passage gives the U.S. exporters a good opportunity to make sure they don't miss any of the foreign tax credit. So if you're asked the question, which way do you go? And know the denominator of the foreign tax credit is the numerator being the foreign source income over the total source income, total income. You want to increase your foreign source income, so you know that where you want to be is on this side when you can control it. When you manufacture your inventory, things change. Again, we talked about this last week, so this is a review. When you manufacture your inventory, it's a little different. This title passage only applies to purchased inventory for resale. That's a good line. That was a good line. Otherwise, manufacturers 50-50. Here's the 50-50 method. We learned two other methods, but we're coming back to the 50-50 method for a reason. U.S. producer, manufacturer puts 50% of the gross profits of the export sales and based on the sales factor, and the other 50% of the gross profit based on property. So let's talk about what this means. If the manufacturer takes 50% of its gross profits and bases the source of the sale of its export sales based on where did it sell, where did the title pass, then it's easy to control. That's not what I want to do. All right, one more second. So 50% of the gross profits of the export sales is going to be based on the sales factor, meaning where did the title pass. So that would be title. Whereas the other 50% is going to be based on where's the manufacturing equipment. The property. This means that you've got the following setup. Take a United States manufacturer where assets are only in the United States. There's not much overseas. And they control the title passing on all foreign sales to be all foreign source. See what it says? Taxpayer passes title to all foreign sales in the foreign country. So the 50-50 method will then allow them to at least take 50% of their gross profit as foreign source. So this is sort of like the worst case scenario, which is not bad. The worst case scenario is really good. Let's figure out why. Again, you've got most of your assets are here in the United States. So all of your, in the 50-50 method, the half of the gross profit that belongs to the allocation by asset will all be U.S. source, 100% U.S. source. But that's only 50% of the gross profit. The other 50% you can control by where the title passes. So for the asset side, it'll be all U.S. source. Okay, so we have to accept that. It makes sense because manufactured here. But for the the export sales, just have the title pass outside. And all that would be foreign source. So the worst case scenario is you get at least 50% of your gross profit from export sales to be foreign source income. And the point of this slide, I think that's what I wanted to do. I'm holding here for a minute. The point of this slide was to show you why it is that and I don't think this is just me, why it is that in most practitioners' practices, uh, any types of manufacturer sales of exports, the 50-50 method, although we learned other ways to do it last week, the 50-50 method is like the golden rule. It's going to usually give you the most foreign source income compared to the other methods. Naturally, you would test it. You wouldn't want to just leave it as a given, but the 50-50 method is what you're going to see most of the time being used, and this is why. Okay, so far so good. I think we can tackle one more major project today. And that's what's known as the indirect foreign tax credit. This is the scenario where now we can, it's a new scenario, but basically on the same thing. We can take the idea that there's a U.S. corporation and they're doing business overseas using, and let's do it this way just for the process of learning it. They're using a per se corporation. They set up business in a foreign country, but it's a per se corporation, so it cannot check the box. Cannot check the box. And it's going to have to be considered a corporation in a foreign country. All right, so you say, well, that's not so bad. You told us that U.S. tax won't be paid until the dividend's paid, and that's true, and that's great. However, if it, when you think about it, I don't know if I can do this. Let me try to see if I can do this. I think that doesn't work. If you think about it, when did, how is, let's talk about the foreign corporation for a minute. We've been talking about the U.S. entity, but let's talk about the foreign corporation up here. The foreign corporation, this per se corporation, pays foreign tax to the country where it's at, but not U.S., and so there's no foreign tax credit needed at that point. But what about when the dividends are paid? When the dividends are paid, it's bringing back money to U.S. shareholders where it's been drained by the foreign tax paid in the other country. Let's look at it this way. Foreign company gets set up. It's a corporation. It's a per se corporation. We can't check the box. So it makes money. That's fine. Doesn't pay tax in the U.S. until dividends are paid. That's fine. But meanwhile, it's paying tax in the country where it is located. So it pays those taxes. Then one day it goes to pay the dividend to the U.S. shareholders. How will the U.S. shareholders pay tax? They'll pay tax on the dividend they receive. Is it foreign source income? Yeah, it's foreign source income coming from a foreign corporation. But do they get a foreign tax credit? Well, how would they get it? There's no foreign tax paid on the dividend unless there's a withholding tax in the foreign country. If the foreign country has a withholding tax, then that's certainly a foreign tax credit, but it's not capturing all the foreign tax paid. How many levels of foreign tax have been paid? Well, let's take a look. Even if there's a withholding tax, we'll do it as WH, even if there is a withholding tax in the foreign country, that's number one, that's one level of tax. But what about what the corporation paid? That's level number two. So it's easy for the shareholders when the dividend's paid to get it foreign tax credit using the withholding tax, because that was paid in their behalf. If the dividend's paid, the withholding tax is taken off of the shareholder's dividend. With the corporate tax, that's not being taken off, that there's no withholding tax, it was just paid by the foreign corporation. So on a level at this point, you have a situation where there's been two levels of foreign tax paid, and only one is being allowed for the foreign tax credit. So in comes the what we call the indirect foreign tax credit. That's this, which basically says it'll be deemed, the tax that the foreign corporation paid will be considered paid off of the dividends that the shareholder is receiving, so they can get a foreign tax credit on it. I think I have an illustration that shows this better. And I do. It's coming up. Let's see what this will help your understanding. There's number one. That's when it happens, the indirect foreign tax credit. Now, often what you have is a situation where the parent U.S. company is a C corporation, being a foreign entity. We call that S for now. When the dividends paid by S to C, which is a U.S. corporation, just so you'll know. Oops, that's not what I want to do. There we go. When the dividend is paid to C, C corporation then pays it to its shareholders. Maybe, maybe not, but it's paid to C. The U.S. C corporation receives an indirect foreign tax credit for the amount of foreign taxes paid by S. That's the whole concept. S paid foreign taxes. There is withholding potentially on the dividends paid from S to C, but there's other taxes that have been paid, and that's the corporate tax. This is nice, and you can study it when you get this on Canvas, but for me, it's not necessary. This is what I wanted to point out. Here is a foreign corporation owned by the U.S. corporation, and it goes year 1, 2, 3, 4 years, makes money, pays taxes to the foreign corporation F, so it pays a bunch of taxes. It made $100, paid $30 in tax throughout the 4 years that it's there. Then at the end of the 4 years, they're going to pay a dividend back to the U.S. company. Let's see what happens. So first, the foreign subsidiary pays the dividend, all of the profits it made, pays the $100. The U.S. corporation will get the indirect foreign tax credit. It'll get credited, it'll get a foreign tax credit as if it paid the $30 out of the dividend that it's getting. It didn't, but it'll get credit for it. Again, the tax was paid at this level, the foreign corporation level, and not on the dividend, but it'll get credit for it as if it paid it. So first example, if the foreign subsidiary pays a dividend, all of its accumulated earnings and profits of the 100, the U.S. corporation will get this indirect tax credit. That's if all the profits are paid. What if it only pays 50% of the profits, meaning it pays a dividend of 50 down here? So it pays $50 dividend, leaving some of the profits inside. Again, remember the example, $100 made over the 4 years, $30 foreign tax paid over the 4 years. So now you pay a $50 dividend, so the U.S. corporation will get half of the foreign taxes paid by the foreign entity, and that's $15. It'll be considered a foreign tax credit. It's indirect because it's called indirect because it wasn't paid on the money as it was earned, and it wasn't even paid on the dividend, but it certainly affected the amount of dividends that could be paid out. because it reduced the amount of dividends that could come out of the company. The IRS is going to want proof of that, so you got to keep good records of what your foreign, and that should be easy in today's world. Keep good records of what your foreign company paid in taxes. All right, that brings us to a good point to pause for a minute and see what kind of questions you may have. So I think we're going to hold here for today, but I want to see what kind of questions you have, and then we can move forward. First of all, I got a question for you. How is the audio now? The last half hour or so. Good. Okay, good. Then I'll wait for some questions. I'm going to wait for a few questions, and then I'm going to sum up what we learned today. All right, seeing nothing at the moment, let me sum up what we did. We first started talking. I got distracted in the first half because of the connection. But we were first talking in general about the concept of outbound taxation and what are some of the issues. Okay, and you can always send questions through an email. Then we started talking in terms of what is it like for U.S. corporations, U.S. companies to do business overseas. And they can do it in one of two ways. They can either, one, just go overseas and do business. That would be what's known as a branch. It's not a separate entity. Since it's not a separate entity, all profits taxed here. All losses recognized here. No dividends. So there's no worries about when you send money back to the parent company. That's one issue. That's one way of doing business overseas. The other way is to set up a separate foreign entity. How do you spell foreign? There you go. Foreign entity. And then the question is, first of all, one question is, we didn't cover this, that's why it's a good thing to do as a summary. One way you set up the foreign entity is you send U.S. assets to get it started. Could be money, equipment. When you send those assets, sometimes it triggers, or I should say can trigger a recapture tax here in the U.S. That's an advanced concept, but I figured you ought to hear it first here. Notwithstanding that, now you got a foreign entity only pays tax in foreign country and no U.S. until dividends are paid. That's what's known as repatriation of the profits. That's where that word comes in, so we've got to get that word into your heads better now. That's what's called repatriation, paying the dividends of what was earned by the foreign company, which is really owned by the U.S. company. Remember, this foreign corporation is owned by the U.S., but it's foreign, so it's not a resident here. and no U.S. tax paid until dividends are paid, which is the repatriation of the profits. That's really what it is. And we were saying that if you're doing, then we learned about the per se corporations. We learned about the check the box rules. We learned the following concept, and again, this is a real good reason for doing this review, the summary. We learned about the concept of, at first, if you are budgeting for losses, you want to be fiscally transparent so the losses flow through to the parent. That's the best planning, that's the best tax planning you could have those losses flow through to the parent. That's great. Now, a few years go by, and suddenly the profits start to be made. Now what do you do? So you go to check the box to be considered a corporation over there. And I just wanted to mention that that's a great idea, but you could, or you need to know that you can only check the box once every 5 years. So you might find that your profits happen too soon, and you'll just have to deal with that. So at first, you might be able to get your losses to the U.S. parent, but when they start making profits, you might have to pay U.S. tax for a while. Usually, it works out because the profits made in the first 5 years, even in best of times, is not that heavy. So the foreign tax pay is not that great, and the U.S. tax paid together with it is not terrible, and the foreign tax credit helps take care of double taxation. You just don't get advantage of the low rates that you might have in the foreign country. So that's the concept with and just as a repeat, the per se corporation doesn't give us that. All right, so I think, and then we learned about the fact that the foreign tax credit has a deemed credit. Why did we need to learn that? Because when you are dealing with a foreign corporation owned by a U.S. parent corporation, there may be withholding tax paid with the dividend, maybe, and that's going to be eligible for the foreign tax credit. But what about the taxes paid by the foreign corporation? So tax paid by foreign corporation, when do you get that credit? And that's when the dividend's paid, it's the deemed foreign tax credit. So we act as if the dividend included the two levels of tax, the withholding tax, if there was a withholding tax, and the tax paid by the corporation. So that's why we talked in terms of two levels, because there's the first level of the withholding tax and the second level of the tax paid inside the corporation. All right, so what else did we do? I think that was the main things that we did. We also did a summary of the sourcing rules when it comes to inventory, where title passage was the key. We also did a summary of the sourcing rules of inventory that's manufactured, and we explained why most companies will use the 50-50 method. We didn't mention that last time, but we certainly went through that today. And now, are there any questions? Okay, seeing none, you will be dismissed summarily until next time. And if you have a question, you can send me the email. I'll try to take a look at it on Sunday.